Yeah, good afternoon, everybody, and thank you so much for joining in. My name is Ganesh from HDFC Securities, and the topic for today's discussion is Portfolio Management Services. The markets continue to be volatile. There is a lot of anxiety amongst investors with respect to their investors. In this context, we are very pleased to present the portfolio management approach to investing with a PMS offering from Nippon India AMC, which is formerly Reliance AMC. We would like to present the high conviction equity portfolio on the PMS side. And to tell us more about this, we have two very distinguished gentlemen from Nippon AMC, Mr. Shahzad Madon, who heads the PMS business and alternate business for Nippon, and a thorough veteran with more than 30 years of experience, and Mr. Varun Goel, who is the head of equities for Nippon. So Team Nippon, it's over to you now.
Thank you so much, Ganesh. First, I would like to thank HDFC Securities for this wonderful opportunity to connect with hundreds of you. There are so many of you attending, and that's very, very encouraging for us. So I thank you for attending. I thank HDFC for attending. And I look after the AIF and PMS business, as Ganesh mentioned, for Nippon India, which was formerly Reliance Capital Asset Management Company. So now Nippon India is 75% owned by Nippon Life of Japan. And in many ways, we combine the best of both worlds. We have an extremely strong parent in Nippon Life, who is among the largest companies in the world, a Fortune 500 listed company. And at the same time, we have the existing team of Reliance, who has delivered a wonderful performance over the last very many years. So with me, I have my colleague Varun, who has delivered all these wonderful numbers. So without much ado, I'll just talk to you a bit about what we do. So at Nippon India, other than you would obviously know us for our mutual funds, but we also manage PMS and AIF, aggregating a few thousand crores across, well, let us say, equities on both the PMS side as well as the AIF side. So today we'll talk to you about our one of our flagship offerings, which is the high conviction equity portfolio. Before I get into that, I just say that across all the equity assets which we manage, what we are particularly happy with, and I'll stress this, what we are happy with is the fact that we have delivered consistently over a period of time. I think it's very important that we deliver superior performance consistently over a period of time. And when you see the numbers, also the numbers which are out there, you can see that over a long period of time, we've consistently, this is our focus. Now, how do we deliver that? Because you see, that is the outcome. But what is the process? And today's topic is also what is the process? How do you deliver that? So through our PMS, across all our equity strategies, we have something which we call our must-5 investment approach. So our must-5 investment approach across all our strategies, and Varun will talk to you more about it later, is the following. So we look at first business potential. We look at the potential for the business, for the industry over the very many years. We look at the potential for the companies which we are in, and we look at the track record of the company. It's very important to us to see the company, see how it is performed and delivered over a period of time. Extremely important to us is also, we would call it the balance sheet of the company. Generally, we have, and you'll see it in when we talk about our numbers for debt equity for this portfolio and all our portfolios in general, we have been very low on debt all through. Now, it is today faddish for people to say that, we're generally not looking at companies with debt, but this is something which has consistently been there across all our portfolios, across all periods of time. So we're very averse to that, both at the company level as well as the promoter level, because so almost none of our companies have any meaningful promoter pledge or no promoter pledge across any of our companies. So we're very focused on that, and good corporate governance. We believe this is the bedrock of our approach. So we call this a must-5 investment approach. It is very much there, and the proof of that is over the years, I'm very, very happy to say that there have been a lot of mishaps in the.
Shahzad sir, just 1 second. Sorry for the disturbance. Varun, I think you'll have to adjust your video. I think it's sort of inverted, or yeah, you'll have to.
Is this
the
okay?
video is coming inverted. That's the message I got.
Oh, okay.
It's fine now. It's fine now.
It's fine.
Okay. Okay. Sure. Sorry, sir. You can continue.
No worry. Wonderful, Ganesh. So thanks for that input. But okay, so One of the things I'm extremely proud about is that over these years, on the PMS side, especially in the industry, you've heard of various mishaps. So people may have got some stocks where there have been, I'm not talking about underperformance, I'm talking about corporate governance issues, etc. And I'm very pleased to say that across all our portfolios, across all these years, we've not had any event. And this, I think we put it to our superior must-five investment approach. So with that broad background, I'll just hand it over to Varun. Before that, I'll just say this, that we are, and I think a lot of you will like it because you are clients of HDFC Securities, so you will like this, I'm sure. We are bottom-up stock pickers. So we are not people who make macro calls and so on. It's not that we don't understand macro or don't look at it, but by and large, we are bottom-up stock picking. We pick those stocks which we believe will outperform the market meaningfully over a period of time. And we are primarily buy and hold. We're not traders. We buy and hold. We buy something with conviction and then we hold it. So with this very, very brief background, I'd like to hand it over to Varun. Varun manages the high conviction equity portfolio among others, and he will take you through why we believe this is an extremely compelling investment opportunity. Varun, over to you.
Thanks, Shahzad. Thanks, Shahzad. Good afternoon to all of you. Thanks for being on the session today. So let us start by talking about what this product is all about. May I request for us to move to the next slide, please? I think we will just take you all through what is the theme of this portfolio and how do we go about picking stocks in this. So we can just go to the next slide. What we will see is that what this portfolio is all about. So we call it the India Leadership Portfolio, and what we mean by that is we pick up those companies and those names, which are leaders in their respective sectors. So what is the core universe of this portfolio is very simple. We're looking at companies which are top 5 in India or top 10 in the world in their respective field of operations. So, it's very simple. So top 5 in India. So again, India is a very, very large market. So if a company is number 1, 2, 3, or amongst top
Varun,
5 in India, it means
Varun, just one second.
A significant level of leadership. Yes.
Varun, just one second. Are you speaking from an iPad?
Sure.
Are you speaking from an iPad, Varun?
Yes.
I think your iPad is inverted. That's
Yes,
the reason
yes.
your overall image is inverted. Your video is inverted.
Okay. No, I'll turn it over. Okay, let us see if it helps.
But I hope what your, on a lighter note, I hope what your portfolio performance के returns दिखे थे वो सही दिखे थे.
Bilkul.
Yeah. Okay, sorry. Yeah, if I could request you, Shyam, to go to slide 2. This is slide 1. Slide 2, please, Shyam. The next one. Shyam, इसके आगे वाला slide. That's correct. This one. Sorry, Varun. Please go on.
Thank you. So this is the slide that I was talking about. As I said, amongst top 5 in India or top 10 in the world in their respective field of operations. These companies, typically what we see is those companies which are in the leadership domain typically have superior performance in terms of revenue, profitability. They typically also have high ROCs and high ROEs, which means higher return on capital employed and higher return on equity. And having established leadership in a fiercely competitive Indian market, most of these companies stay nimble and hungry, and thereby a lot of them become globally very, very competitive. So for instance, a lot of these auto ancillary companies you see, they may be a mid-cap company in India, but globally they are leaders in their own field of operation. So we'll talk about a lot of such examples as we go forward. So what we have done is we have created a bouquet of these companies. So we are around 21 names in this portfolio across different sectors, companies which continue to maintain their dominance and the leadership. Also, very importantly, if you see in the last 3-4 years, Indian economy is undergoing a lot of disruption. We are seeing a lot of shift of business from unorganized to organized. And what we have seen in that in most of the categories, the profit pool is almost 100% now moved to the top 4-5 players. Even though the revenue share of these top 5 players might be more like 60, 70, 80%, but almost 100% of the profits are typically generated by the top 5 players in every segment. And hence it becomes extremely important to be participating in these companies. Can we move to the next slide, please? Slide 3. Yeah. So if we just go down, we will see what other. Yeah. Can we move to the next slide? Slide 3. Yes. So okay. So what do we mean by leadership, right? So leadership could be in different ways, right? It could be a leadership because of a very strong brand. It could be because of innovation. We have seen a lot of technology-led breakthroughs because of which a lot of companies in India are leaders in technology. And of course, we have examples of size, right? Some companies become so big in size that the size itself becomes a competitive advantage. And then there are a lot of niche areas, right? So companies which identify their own small domain of operations and they become the leader in that operation. So for instance, we have a company called AIA Engineering in this portfolio, which is a global leader in ferrochrome alloys, which goes into most of the mining sector. And it remains amongst the top 2 companies in the world to be present in this field. And finally, you have cost leadership. Clearly, you have seen, let's say the best example is the telecom space, where Indian players are actually one of the lowest cost telecom players in the whole world. Our data cost per unit, let's say price for 1 GB of data in India is the lowest anywhere in the whole world. And that's how some of the telecom companies in India have attained leadership. So what we have done is that we are looking at all these parameters and saying that what are those names which have this dominance, and they have maintained this dominance for a very long period of time. So we identify these things. So we have come up with actually more than 100 names in India. 100 companies are spread across different sectors, large, mid, and small, which are demonstrating these characteristic traits. And based on that, both qualitative and quantitative filters, we have identified a portfolio which we will share with you as we go forward. Can we move to the next slide, please? Slide 4. Can we go to slide 4, please? Yes. Next one. Yes. So what we have done is we have created a multi-cap portfolio, and here what we have done is that we maintain around so while the overall range is 40 to 80% large cap, but typically we have around 60 to 70% large cap. So today we have around 65% of the portfolio in the large cap space, and we have around 35% of the portfolio in the mid cap space. So this portfolio, of course, can have wider range, but typically what we have seen is that if you want to have a more stable, sturdier portfolio, especially in volatile times, it's a good idea to have 50, 60, 65% kind of portfolio in the large cap space, because that gives portfolio a lot of stability even during tough macroeconomic environments. And then, of course, you add alpha to a lot of mid and small cap ideas. For instance, today we have around 35-40% of the portfolio in that space. Again, all companies which are leaders in their own segments, but they just happen to be small and mid cap companies. So this is how the portfolio construct is. Can we go to the next slide, please? Can we go to slide 6? Yeah. So this is just to share the returns. I think one very important concern or fear that all of us have, and what we have seen in the last 6 months of COVID, is that a lot of correction which has happened in the market has led to a lot of value destruction. Of course, there are a lot of concerns about how this illness will play out. But even during this fall, we have seen that the portfolio has fallen a lot less as compared to the benchmark. And of course, if you see on the full year basis, the portfolio actually, when the markets was doing well, actually outperformed during that time also. So portfolio has done well on both sides, both on the upside and on the downside. And the reason why that has happened is because of our very strong must-5 investment framework, which Shahzad briefly spoke about. And we will of course go through the contours of those must-5 investment framework. So can we move to the next slide, please? Slide 6. Yes. Sorry, if you can just stay. Can we scroll down a little bit? Scroll down. I was first want to talk about the must-5 investment framework. Yeah. Can I request you to please scroll down towards the second? Yes. Thank you so much. So what we are talking about is the must-5 investment framework, and as I mentioned, this is a uncompromising focus on quality. There are 5 key things that we are looking at before we buy any stock, in our PMS or AIF products. So what we do is that we first look at the growth opportunity. What is the scale of opportunity which is available? So most of these companies that we are buying in this portfolio have a very, very large market opportunity available. And as such, having 15 to 20% growth for the next 3 to 5 years is not difficult to achieve. Second, very, very important thing, especially in today's time, is corporate governance. We have seen that how some of these companies, have suffered because of shareholder pledge, some accounting issues. Last 3-4 years, a lot of banks and NBFCs have gone bust because of poor quality of underwriting. So we try and ensure that the companies that we are buying, does not have any accounting red flags, does not have any poor track record of promoters, does not have any bad track record of treatment to minority shareholders, and which becomes extremely critical. Like we saw in the case of a media company, a large shareholder pledge led to a lot of wealth destruction. So we believe if we follow this framework properly, we can avoid some of those issues. Third, of course, is the earnings track record. We are consistently looking at good earnings growth even in the last 3 years. So any stock that we are buying, typically our idea is that it should have delivered good earnings growth even in the preceding 3 years, and we expect good growth in the next 3 to 5 years. We are also looking at consistently ROEs of more than 15 to 20% the last 3 years, and I'm happy to share that at the portfolio level, if we look at trailing ROE, return on equity of the portfolio, is upwards of 15%, even in a very, very difficult macroeconomic environment. And then we come to promoters' ownership. Companies, we typically tend to avoid companies which have very little promoter stake, 20-30%. That is normally not a sign of a very stable company. As I said, shareholder pledge becomes very, very critical. And I'm happy to share that there is no company that we own which has any shareholder pledge at all, any promoter pledge at all. And finally, capital allocation is extremely important. I think here leverage becomes extremely important. I'm very happy to share that, to the exception of telecom sector, and of course financial services space, none of the portfolio companies has any debt, right? So our average debt to equity in the portfolio is 0.9, 0.19. Sorry, the average debt to equity of the portfolio is around 0.19, which is extremely low. Around 75% of the companies have zero debt or negligible debt, and we are therefore ensuring that in these times of COVID, if you have 3-4 months of no revenue, no profits, it should not lead to a problem of cash flows. Normally, when these companies have no debt or little debt, they are able to tide over troubled times like the ones that we are currently seeing. So this remains our primary focus in terms of portfolio construction, and we will try and ensure that we continue to adhere to this even going forward. Can we move to the next slide, please? Slide 7, where we will just share the whole portfolio. Yeah, so this is the whole portfolio, as you can see in front of you. This is a very healthy mix of leaders, as we know, blue chip names in the banking space, right? Blue chip names in the pharma side, blue chip space, stocks in the IT space. But at the same time, we have a very, very large exposure to small and mid-cap companies, and that exposure is also, as you can see, fairly strong, in the sense that chemicals as a space, we have more than 10% exposure, and we are quite convinced that the next big sector to emerge out of India is the specialty chemical space. We were one of the first few investors to start investing in chemicals around 3.5 years back, and we have seen several multi-baggers emerge in this space. So as you can see, the top holding today in the portfolio is a company which has done extremely well in the last 5 years on the specialty chemical space, and we continue to believe that this segment should show very, very strong growth. One important thing about India, I think while we have missed the bus as far as manufacturing in several sectors are concerned, so we lost the bus on textiles to countries like Vietnam and Bangladesh. We lost the bus as far as semiconductors and automobiles are concerned to countries like China and Taiwan and Korea. But as far as chemicals is concerned, we have had a very, very strong base. India has had a strong chemistry skills, and we are seeing, today a $35 billion industry exists even today, and we believe that this can become a $100 billion industry, in the next 6 to 7 years, and that's where we believe a lot of multi-baggers will emerge. Then you see, we have companies in the consumer durable space, thanks to the revolution that we have seen in the last 5 years in terms of access to electricity. I know we have seen even tier 2, tier 3 India now buy consumer durables like ACs, like refrigerators and washing machines. And of course, now that the consumer finance is available cheaply and is available to everybody, we have seen that that the space continue to do well. So what we are, the way we are currently looking at the portfolio is that around half of the portfolio, around 50% of the portfolio is in sectors that we believe are relatively very less impacted by the COVID situation. So as you can see, we have around 10-11% of the weight in the chemical space, which, as I said, is a key ingredient in pharma and FMCG, and as such has been doing very well with very little disruption. We have around 15% of the portfolio in the consumption side, and there again we've seen that whether it's food companies or consumer durable companies, they're all doing well despite a tough environment, and we believe that this sector again remains relatively less impacted by the COVID related disruption. In the healthcare space, again, we have more than 10% exposure to pharma companies, and then we have another 5% exposure to health insurance company, a general insurance company, again a sector which has done very well in a very tough environment, because we believe that health insurance as a space will expand as more and more people buy health insurance, and they are looking to buy a larger cover for that. The fourth sector that we believe will do very well despite this COVID related disruption is the tech space, especially the digital side. So as you can see, we have a fairly large exposure in one of the India's most prominent digital companies. This is a digital platform through which a lot of us order food, a lot of us go to their websites to find jobs and to buy or rent a house. So these are all digital platforms where in COVID times have become even stronger as we do more and more things sitting at home. We believe that the digital sector in India will grow at a very fast pace. And finally, the fifth sector that we believe is relatively immune from this COVID-related disruption is telecom. And we have around 10% of the portfolio again in the telecom space. Again, something that we see will do very well going forward. We have seen a lot of competition getting bust, and there are now only 2 or 3 players left in the industry. Pricing power is really coming back, and we see earnings growth really accelerating in this sector. So we have around 50-55% of the portfolio that I can say is impacted, but very little impacted in this current situation. And that's the reason why we've seen these sectors do very well in the last 3 months of disruption. And then we have a lot of names as a bottom-up stock picking in terms of sectors that are leaders in their old field. So for instance, we have a mid-cap cement company, which is the lowest cost producer of cement in India and done extremely well in a tough environment. We have some companies, in the tire space, companies which are global leaders in terms of cost, and they are able to provide off-the-road tires at the cheapest cost anywhere in the world. And that again, we have seen company doing extremely well in a tough environment. So overall, as you can see, the total number of stocks are around 24. The portfolio is largely stable. We have not done much change even in this COVID environment. It's very difficult to predict, how this environment will play out. Our base case remains that as of today, India's economy is operating at around 60-65%. We believe by the end of September, economy will largely normalize. We should see 90-95% of the economy becoming largely functional by end of September, and hopefully by quarter 3, quarter 4, the economy should come back on track. If it was not for COVID, we saw significant recovery in Indian economy in the months of January and February. As we are seeing in the result season also, companies actually did quite well in the month of January and February. And we hope that post-September, Indian corporate world can actually go back to a high earnings growth environment. This year, of course, earnings growth will be severely impacted. It is very difficult to pencil in the numbers, but our sense is from what we were expecting in the beginning of the year, the earnings will need to be downgraded by around 20-25%. But I think one very important point is that if we believe this is a one-off thing, if this is a 3-month, 6-month disruption to the economy, not just in India but across the world, then Indian economy and Indian markets should be able to tide over this crisis fairly quickly. So of course, this is assuming that there is no second wave. This is assuming that there is no elongation of this problem. But assuming that it's 6-month problem that the world is facing, even if you were to assume Indian corporate world's profits getting wiped out by 50%, let's say in a worst case scenario. Let's remember that when you value companies, you value that based on future cash flows. So if the average life of a company is around 20-25 years, even if you lose 1 year's profits, the valuation of the company should come down by maximum 3 to 5%, and not by 20, 25, 30, 40%. The kind of correction that we saw in the month of March. So very quick word on how markets stand. So of course, even before India entered into a lockdown, Indian markets bottomed out on 23rd of March with markets level at 7,500. So we fell down from 12,500 to 7,500, a fall of almost 40%. Even before India went into lockdown, I remember clearly that time the casualties were less than 20 and total number of cases were less than 300. And the reason why market reacted that violently, is that because people were expecting that this will become a major problem. There were some journals and reports in Western world where they were seeing millions of people will die and there will be dead bodies on the street. And thankfully, there is nothing like that we have seen. Agreed, there is a problem, but we believe we can, as a country, tide over it. And the reason why the markets are rallying currently, obviously, is because things are not as bad, nowhere as bad, as people were expecting in February and March. So we are not saying that markets cannot correct a little bit, but our sense is, barring any big second wave, barring any big restart of the illness, we might have seen the worst, and gradually, by September, October, economy should be on a recovery track. From a valuations point of view, the market today is fairly valued in the sense that we are looking at 16, 17 times on 1 year forward earnings. This is the 10-year average P that the market has traded. So market is definitely not expensive. If we assume 10 to 15% earnings growth in Nifty companies for the next 3 to 5 years, there is a lot of returns which can be made by any investor who's coming in the market at this point of time. So I think with this, I will end my presentation, and maybe we can open the floor to questions.
Great. Okay, thanks. Thank you so much, Varun and Shahzad sir, for a wonderful session. So we have some questions, so we'll take it one by one. We have time for a couple of questions due to paucity of time. So can you just briefly touch upon the market cap composition of this portfolio currently? Is the first question that we have.
Yeah, so this is a multi-cap portfolio, as I mentioned. We have around 65% of the portfolio currently is in the large cap space, and the remaining 35 is in the small and mid cap space. So this is a good mix of large, mid, and small. I think one very important point to remember is that a lot of multi-cap portfolios, if you look at the mid-cap bull run in 2017, a lot of multi-cap portfolios had become very heavy on mid-caps. And then when the tide turned on mid-caps, a lot of portfolios ended up underperforming and saw a lot of wealth creation, wealth destruction. So our sense is, this is a core equity portfolio. This is something that we believe investors can hold for 5 years, 10 years, 15 years. And therefore, from a portfolio stability point of view, we believe it's a good idea to have 50-60% large caps at all points of time and have a good mix of small and mid cap ideation, which can provide the necessary kicker and the alpha for the overall portfolio.
Okay, great. The next question is, any specific percentages that you have assigned as benchmarks for your promoter holding, ROC, and your ROE?
Yeah, so see, we are very clear that we want companies, our average portfolio level ROE, if you look at 9-month FY20 numbers, the last quarter numbers are still coming in, but on a 9-month basis, the average ROE of the portfolio was around 19%. So we are very clear that we are looking to buy companies with ROEs about 15 to 20%, and at the portfolio level also, we will ensure that the portfolio average ROE remains in that band.
Okay. Okay. So the next question is pertaining to the COVID thing. The COVID impact is still not over. How do you look at the markets in the short term now?
Yeah, see, it's very difficult to predict the markets in the short term. As I said, market is always forward-looking, and I think a lot of us are surprised by the intensity of the recovery that we are currently seeing. I think a lot of it is to do with the fact that markets are seeing a reopening of the economies across the world. Markets are seeing a lot of improvement at least in terms of death rates across the world. In several markets, there is also a lot of monetary stimulus which has been unleashed. So typically in countries like US, in Europe, in Japan, we have seen a lot of easing of monetary policy, and a lot of money gradually will go into asset markets. As you can see, US markets are already at life high, and I think as the Western world stabilizes, as India also sees some kind of stability, we are going to see some of that money coming into Indian markets also. While it's difficult to predict short-term market movements, uh, and of course, the illness is still not gone, so we have to wait and see if there is a second wave or anything like that. But barring any big second wave, as I said, we don't expect a retest of that 7,500 level that we saw in March. Yes, from where we are, can we have a 5-10% correction? It is definitely possible. This will be a function of how the illness really plays out. But our sense is any investor who's coming with a 3 to 5 year point of view, there is enough money on the table. The valuations are much more palatable at this point of time. And as I said, if this is just a one-time thing, in your DCA valuation, you shave off 3 to 5%, and not 20, 30, 40, 50%, which is the kind of price damage that we have seen in the portfolios. Also, what we would advise investors is that for those investors who are worried about the next few months, it is a good idea to spread out their investments over the next 6 to 9 months. So we have options of, let's say SIPs. So I would suggest rather than sitting out completely from the markets, a good thing to do is have 30, 40, 50% invested right away if you have concerns about how COVID is going to play out, and then spread over the investments over the next 6 to 9 months.
Varun, if I may just add to that, a lot of the investors, as I understand it, Ganesh, are investors with existing equity portfolios, so who are in many ways already committed to the market, right? Which is great because, I'm sure you've seen the fruits of long-term investment in that. So for those sort of investors, also, of course, if you see merit in this portfolio, because we've been, to our mind, consistent both on upside and downside. I think that's very, very important because there are people who protect downside, but on the upside they don't capture as well. We've done fairly well on both. So from that perspective, in addition to what Varun said, fresh money can of course be brought in over a period of time, or existing portfolios. Should you see the merit in what you are in the high conviction equity portfolio, you can do a portfolio transfer, and you can actually then participate in through a diversified portfolio, which is what we are offering of leaders, which we are offering.
Okay, great. Okay, so I'll take the next two questions, which is what is the minimum amount of investment in a PMS? So the minimum investment amount in a PMS is 50 lakhs. This is as per SEBI regulation. The next one is how to initiate the investment, how to get started. So, okay, so you can get in touch with your relationship manager, and we will assist you in all the documentation, and the Nippon team is also available for us for assisting us for documentation. Okay, the next question is what kind of themes do you see emerging post the COVID scenario?
I think the COVID theme again reinforces a very, very strong theme that was playing out in India even earlier. One is leadership, in the sense that, as I said, today almost 100% of profits in every sector are being cornered by the top 4, 5, 6 players, right? So we have seen a massive consolidation in every sector, post demonetization, post GST. If India has to become a $5 trillion economy 3, 5, 6 years down the line, we need to be more formalized. And as such, we are seeing consolidation and shift from unorganized to organized. And those companies, which are beneficiaries of this shift from unorganized to organized, will do well. The larger names will become larger. That's our sense. Larger, not in the sense of absolute size, larger in the sense of leadership in their own respective sectors. And second, I think very, very important trend which gets reinforced is that the strength of the balance sheet is extremely critical in times like this. For instance, let's say if there was a company which had a lot of debt, and then suddenly you are shut down for 3, 4 months, you have to pay a fixed cost. Some of those companies can actually have survival issues. They could actually go down and default on their debt because there is no revenue and profit which is coming in these times. And therefore, if you want to invest in the company from a long-term point of view, if you want to create wealth, it is important that the balance sheet is very strong. And that is again something which gets reinforced in this COVID crisis.
And I'll just add to what Varun said, which is what Varun mentioned earlier. We are playing through our portfolio. Those who are more digitized, right? So we do have some players in our portfolio. You can look at the names. We mentioned about, somebody who they're involved with food delivery, food tech. There's somebody, there's also the job portals, etc. We've got one company who does online advertising. These companies plus financial services and a lot of those wellness, health, insurance, etc. All those themes, people are focusing on that much more. So the two main themes Varun said, and you add to this all of this. So a lot of the banks and financial institutions continue to operate fairly smoothly, partly because they're digitized also. And some of these other themes, the health insurance and financializations, those two themes will get that much more highlighted and will benefit from what's happening.
Okay, sure. Okay, the next question is, okay, there are few areas to look out for, which look to create opportunities over the next 10-20 years. Examples: drone making listed firms, Netflix kind of firms where subscription model is present. As internet penetration reaches 70-80% and more, what are your views here?
Yes, I think we have to look at what is available today in the listed space, and we also have to ensure that the names that one investing in is a good balance sheet and is a profitable company. So there are a few names which are listed, and amongst them, we are present in the largest player, as I said, who's present in various verticals like food delivery, job portal, and real estate advisory and brokerage. So these are sectors, again, wherever there is an intermediary, can the digital platform eliminate the digital intermediary? So that is again something that we see we're doing very well as a space. Similarly, we are also seeing companies doing very well in terms of entertainment, like you mentioned, in terms of content. There are also companies which are also benefiting from advertising in the digital space. As you know, advertising is moving more from newspapers and TV to net, where you can do more targeted advertising, and that's also has a much larger customer engagement. So these are all companies which are there available. There are companies which do ticketing. There are companies which provide us all kind of delivery and merchandise products. So there is going to be an opportunity which is going to open up. As you know, one of the very large names in India has just started delivering groceries, right? So we are seeing now a listed play in terms of grocery delivery in India, something which didn't used to exist a few months back. And we are seeing a coming together of telecom as a business and food delivery and retail. So we are seeing one of the companies which has presence in all the three verticals and aims to become the largest player in the country in that space. So again, that's something that we are invested in, and we believe this can become a very, very large and scalable opportunity going forward.
Okay. Okay, the next question is, what stocks do you suggest to make an 8-10% return in 6 months horizon from now? Okay, I suggest that if you can just get in touch with your relationship manager, and we give stock recommendations. We give a weekly stock pick as well, so we can advise you on that as well. I would just request you to get in touch with your relationship manager, who will surely help you out. Okay. So we'll take the last two questions. Any exposure in the global markets in this portfolio?
See, we, as a policy, we have not taken any direct exposure in the considering the fact that most of the global commodity companies are debt heavy, and if the cycle turns, we see their profitability getting impacted very, very severely. We do have an indirect play through one of the companies, as I said, one of the mid-cap companies, which is the second largest ferrochrome alloy company in the world. their products go into the furnaces of every steel company in the world. Right? Their products go into the cement manufacturing plants all across the world. So it is an indirect play. It's a cash-rich company, ROE of more than 20%, delivering very, very consistent earnings for the last 20 years. So that is something I know that we like to play, and that it is through that we will play the global recovery cycle.
Okay, the next question, I'm sure you would have faced this question a lot of times as a fund manager and as heading a business. What is the impact of border tension? How do you view this exactly from an investment perspective?
Yeah, so I think maybe Shahzad can add from a broader level, but from the way I look at it from the portfolio point of view, is that these things are extremely tough to predict. And in the short term, of course, there is a lot of stress and anxiety. We are seeing, as of today, some of the companies are facing problems in terms of shipments coming from China. We heard a company, one of the portfolio companies, speak today morning about they're looking to replace some of the China vendors. So I think some of these things will happen, and some of these companies might end up actually becoming a lot less dependent on China in terms of the supply chain and having their own, delivery lines focused on India or some of the other closer countries. So I think this is a global reset which will happen not just for India, but across the world. If you see, ever since the US-China trade war has started, there is a gentle, slow, change of supply chains. And India, again, can be a big beneficiary, like we're seeing in the chemical space. A lot of companies, as they exit China, a lot of American and European names are coming to India. I think we will see a lot of mobile phone companies also coming into India, and we're seeing that category also becoming fairly large. So I think there might be some new winners which will emerge. Obviously, there will also be some losers. But today, how the portfolio is positioned, I'm not particularly concerned, because we do not have any particular company, which is going to be very badly impacted, even if this situation becomes actually a lot worse. Of course, there could be a different matter that the overall market sentiment turns different or turns for the worse. But from a portfolio construction and an individual company level point of view, I don't see a very, very large impact.
Yeah. So that was the last question that we could take. We'll have to end this session due to paucity of time. So thank you so much, dear investors, for sparing your time for us and for joining in for this webinar. We do hope you found this session useful. And thank you so much, Mr. Shahzad and Varun, for a wonderful session. Thank you so much for joining us. I'm sure our investors have also greatly benefited from this. Thank you very much.
Thank you. I'd just like to thank HDFC Securities, of course, for this wonderful forum, and all the investors who have attended in such large numbers and have given us such a patient hearing. So thank you so much, and all the best. Have a great weekend.
Thanks.
Thank you. Thank you.
Thank you.